Most business owners and real estate investors are about to waste the biggest tax opportunity they'll see in this decade, and they don't even know it. The 2025 One Big Beautiful Bill quietly rewired how your income, your properties, and your spending get taxed, and many people aren't aware of how it works. And if you keep running that old tax strategy, the IRS will happily take tens of thousands of dollars that could have stayed in your pocket. And don't think I don't need to know that because I have a tax professional who takes care of that for me. Don't assume they do, and don't assume they know what all is in that bill. You know what's available to you and what questions to ask. We're going to talk about it. If you run a business, if you own rentals, or if you're trying to build real wealth, this 2025 law can either be a weapon you use or a hammer the IRS uses on you. Most people are on track for the hammer. I want you in the first group. By the end of this episode, you'll understand the key parts of the One Big Beautiful Bill that actually matter for small business owners and real estate investors. And you'll walk away with a simple 7-play checklist you can literally hand to your CPA.
Welcome to the Tax Strategy Playbook, the show where smart investors, business owners, and real estate pros learn how to win the game the IRS wrote. Each episode, we break down powerful strategies, expert insights, and real-world examples that help you keep more of what you earn. Because here, it's not about working harder, it's about working smarter with your taxes, because tax evasion is a crime, but tax avoidance is mandatory.
Hey everyone, I'm David Wiener, real estate tax strategist and host of the Tax Strategy Playbook. I spend my days helping business owners and investors use things like cost segregation studies, bonus depreciation, and smart entity design to keep more of what they make and accelerate wealth through the tax code, not in spite of it. And the reason I'm doing this episode right now is simple. The rules have changed in a big way, and many people aren't aware of what was in it. In January of 2025, we got what's now being called the One Big Beautiful Bill. I'm not going to get into the politics of it. I don't care which team you root for in D.C. My job is to look at the scoreboard and say, okay, under these rules, how do business owners and real estate investors win? Here's how we're going to do that today. I'm going to split this episode roughly 50-50. Half of our time will be focused on small business owners, LLCs, S-Corps, service businesses, brick and mortar, online businesses. The other half will be focused on real estate investors, buy and hold, value add, small multifamily, even people investing passively in deals. And we're going to talk through 5 big themes. Number 1, how the bill changes the way your income is taxed, especially that 20% deduction everyone loves to ignore. Number 2, how 100% bonus depreciation and expensing can turn your spending into legal tax nukes. Number 3, how the law quietly changed the math on debt and interest deductions. And number 4, what's really going on with the no tax on tips and overtime headlines and the SALT cap. And then finally, a simple playbook. 7 concrete moves you can make in the next 30 to 60 days. So if you're listening while driving or at the gym, stay with me. This might be the most profitable 30 to 40 minutes you spend all tax year. So let's start with the foundation, how the new law treats your income. Let's talk about something that sounds boring, but actually is one of the biggest levers in the entire bill, the 20% qualified business income deduction, or QBI. If you own a small business through an LLC, an S corporation, or a partnership, QBI is essentially a permanent 20% off coupon on your business profits, if you qualify. Here's what it means in real life. Imagine your business nets $300,000 a year. If that income qualifies for QBI, you may get to deduct 20% of that, $60,000, right off the top of your personal return. If your combined tax rate is around 30%, that's roughly $18,000 in tax saved every single year. Before this new tax law, that deduction was on a ticking clock. There was a sunset date. Now with the One Big Beautiful Bill, that deduction isn't here just for a while. It's baked into the code in a much more permanent way. That changes how you plan. So what do you do with that? If you're still operating as a sole proprietor on a Schedule C, or you have an LLC that's never been looked at strategically, now is the time to do that. Here's the key concept. QBI is based on your business profit, not on the W-2 salary you pay yourself from an S corporation. So if you're an S corporation owner, you need to be very intentional about your salary versus distributions. If your salary is too low, you're playing with fire on reasonable compensation and maybe drawing the attention of the IRS. If your salary is too high, you're killing your QBI because every dollar you push from profit into W-2 wages is a dollar that no longer gets that 20% haircut. I'm not saying underpay yourself. I'm saying match your salary to reality and then design your structure so that you're not accidentally giving away your own QBI. Now, for real estate investors, if you own rentals, you might be thinking, okay, David, but I'm not a traditional business owner. Here's the thing. A lot of rental activities qualify for QBI as well if they rise to the level of a trade or business. That means your rental income might also be eligible for this 20% deduction, especially if you're actively managing your properties, you have systems and regular activity, and you're not just parking money in a single passive triple net lease. For hybrid folks, maybe you run a construction company and also have some small multifamily. This is where things get fun. You've got QBI coming off the operating business and potentially off the rental side as well. Let me give you a quick example. I worked with a client who runs a marketing agency and 3 small rental properties. Before, they were just a Schedule C and 3 rentals in their personal name. Their CPA was filing returns, but there really wasn't any tax strategy. And you know what I say about a tax preparer versus a tax strategist. You must have a tax strategist that you work with. But under the new law, we look at this and we say, okay, should the agency be an S corporation to unlock QBI and make self-employment taxes more efficient? Should the rentals be in an LLC taxed as a partnership so we can treat them more clearly as a trade or business and track QBI properly? And how do we coordinate their salary from the agency with the profits from both sides? All of that only matters because the 20% deduction is now a long-term tool instead of a short-term coupon. So the takeaway from this theme 1 is your entity structure and your income mix are no longer administrative details. They're a core part of your strategy under the One Big Beautiful Bill. And so if you haven't reviewed your structure in light of the 2025 changes, that's play number 1. You should also listen to the episode we did on entity selection. That'll help a lot. All right, let's talk now about the fun stuff. Spending money, yeah, and writing it off faster. So under the new law, 100% bonus depreciation is back in a big way. To me, as a cost segregation provider, that's a big deal, and we crossed our fingers and waited for a long time for this. Here's what it means in plain English. When you buy certain types of assets, equipment, machinery, some vehicles, furniture, certain improvements, you may be able to deduct the entire cost in the year you place it in service instead of slowly depreciating it over 5, 7, or more years. Let's say you own a construction company. In 2025, you buy $200,000 worth of qualifying equipment. Under the old rules, maybe you'd depreciate that over 5 years, so you'd get about $40,000 a year in deductions. With 100% bonus depreciation, that $200,000 can be $200,000 deduction in the year you placed it in service. If you're in a 35 to 40% combined tax bracket, that's $70,000 to $80,000 tax savings right now. So does that mean go buy new toys? No. It means if you're already planning to grow, upgrade, or expand, you ought to be timing those purchases and coordinating them with your income because timing now matters more than ever. You can also layer this with Section 179 expensing, but there's a catch. There are limits on how much loss you can use in any one year, and states don't always follow the federal rules. So the point is to plan, not just to slam everything into 1 year blindly. Now let's take that same concept to real estate. If you buy a rental property, you normally depreciate the building over 27.5 years for residential or 39 years for commercial. That's slow. That's a lot of years. A cost segregation study breaks your property into pieces. carpets and cabinetry, appliances, parking lots, sidewalks, certain electrical and plumbing components. Many of those pieces are what we call shorter life property, 5, 7, or 15-year assets. Under the One Big Beautiful Bill, a huge portion of that short life property can qualify for 100% bonus depreciation. Here's how that changes the game. So let's say you buy a $1.5 million small multifamily building, and you put another $300,000 into renovation. A good engineering-based cost segregation study might identify, say, $400,000 to $1,000 of that total as short life property. Under this new environment, that $400,000 to $1,000 could be fully depreciable in year one. If you or your spouse qualify as a real estate professional, those losses might not offset just rental income. They can offset other active income as well. That's where we see people using one or two well-timed acquisitions or renovations to wipe out enormous chunks of taxable income. So let's pull it all together. When you combine these, a business that's buying equipment and vehicles, a portfolio that's buying and renovating properties, and a law that gives you 100% bonus depreciation across both worlds, you can see how someone running a business and buying real estate in 2025 or after has a once-in-a-decade opportunity to front-load deductions. You don't buy assets to save tax. You buy assets because they move your business or your portfolio forward. But if you're going to make those investments anyway, the timing and the structure now have a much bigger impact than they ever did before. Okay, so we've talked about income. We've talked about assets. Let's talk about the thing that most people fear most, debt. The One Big Beautiful Bill also changed how much of your interest income expense you can deduct. I'm not going to throw code sections at you. Here's what you need to know in plain language. There's a rule that limits the deduction for business interest based on a percentage of your income. Under the new law, that rule is more generous for many businesses because it looks at income before certain deductions instead of after. So what does that mean in practice? For small businesses, if you're financing growth, buying equipment, acquiring another company, or even buying an owner-occupied building, more of your interest expense is likely to be currently deductible instead of being pushed into the future as a carry forward. That effectively reduces your after-tax cost of borrowing. Again, it's not a license to load up on debt. It's an invitation to model your growth with accurate assumptions. If your projections are still based on pre-2025 interest limitation rules, you may be underestimating your after-tax cash flow. For investors and syndicators, this gets even more important. If you're doing highly leveraged deals, maybe 70 to 80% loan-to-value on a commercial property, your interest expense is a major part of your pro forma. If more of that interest is now deductible in the current year, that can improve your after-tax returns. Will it save a bad deal? No, but it can turn a decent deal into a very strong deal when you run the numbers correctly. If you're raising capital, this is something your projections and offering documents should reflect. Sophisticated investors will ask, what tax assumptions are you using? You want to be answering from the After 2025 playbook, not from memory. So the takeaway from theme 3 is this. Don't change your philosophy on debt just because the law changed, but absolutely change your math. Let's hit the headline-grabbing stuff quickly because there's real money here too in tips, overtime, SALT, and high-tax states. You may have heard the political slogans, no tax on tips, no tax on overtime. It's really more nuanced than that. The law created new deductions that can effectively remove federal income tax on certain tip and overtime income up to defined caps, and those benefits phase out at higher income levels. Here's what matters to you if you're an owner. If you own a restaurant or a bar or a salon or a hospitality business, any environment where tips and overtime are a big part of compensation, this is both a recruiting and retention tool and a compliance challenge. You need to be able to clean up your tip reporting systems. You need a payroll that's set up correctly. You need education for your staff so they actually understand what this means for their paychecks. If you're an owner-operator who still works in the business and earns tips or overtime yourself, This can be a direct tax benefit, but again, only if the reporting is done right. This is a systems and education opportunity, not just a line on a tax return. Next, let's talk about the SALT cap. SALT stands for state and local taxes. Under older rules, state and local tax deductions were capped at a relatively low number. The new law significantly increases that cap for many taxpayers for a period of years, with phase-outs at higher income levels. For you as a business owner or a real estate investor in a high-tax state, this means more of your state income taxes and property taxes may once again be deductible on your federal return. The effective paying of high property taxes might be slightly less than it was before because a bigger slice shows up as a federal deduction. Does this suddenly make every high-tax market a screaming buy? Of course not. But if you write big property tax checks each year, or you live and invest in a high-tax state, you want your tax planning and your deal underwriting to reflect the new SALT reality, not the old one. So the takeaway of theme number 4 is the headlines aren't the whole story, but they're not nothing. For some of you, tips, overtime, and SALT will be meaningful pieces of your strategy. At this point, you might be thinking, okay, David, this is a lot. What do I actually do? Let me give you a simple 7-play checklist that you can use. If you're multitasking, come back to me for a second. This is the part you want to write down, screenshot, or grab from the show notes. For small business owners, play number 1, review your entity and compensation. Am I in the right entity? LLC, S Corp, partnership, to maximize the 20% QBI deduction. And ask, is my salary versus distribution mix intentional, or did it just happen a few years ago and really never got revisited at all? Play number 2, map out 2 to 3 years of capital spending. List the equipments, the vehicles, the build-outs, and the tech you know you'll need. Decide what to accelerate into 100% bonus depreciation years and what to stage. Play number 3, rerun your debt and growth projections. For existing loans and planned loans, update your cash flow projections using the new interest deduction rules. And make sure your CPA or tax professional is modeling the 2025 law, not the old assumptions. And don't you dare assume that they are. You ask them. Play number 4. If you're in a tipped or overtime heavy industry, fix your systems. Clean up tip reporting and payroll. Educate your team so they don't leave benefits on the table or create problems by misreporting. For real estate investors, play 5 is identify properties for cost segregation and 100% bonus depreciation. Flag properties bought or significantly improved in 2025 and beyond, and then contact me to see if a study makes sense economically. I can run a free estimate for you on any property that will show you exactly what the study will cost and what your approximate tax benefit will be, so you have something objective to look at. Play 6 is going to be reassess real estate professional status and groupings. Ask, do I or my spouse qualify as a real estate professional? If not, is it realistic or even desirable to get there, or even possible? And then discuss grouping elections and QBI eligibility for your rentals with your tax advisor. Play number 7, re-underwrite deals for SALT and interest. If you live or invest in high-tax states, revisit your SALT assumptions and whether you'll itemize. And update your deal models for the new interest rules, especially on higher leverage deals. If you walk into a tax planning meeting with just these 7 plays written down, you're going to have a far more valuable conversation than, so, how did we do this year? So let's land this whole thing. The One Big Beautiful Bill did a lot of things, but for you as a business owner or a real estate investor, it really did 3 big things. First, it gave you certainty around some powerful tools, like the 20% QBI deduction. That means it's time to stop treating your entity structure as an afterthought and start treating it as a core part of your strategy. Again, check out our episode on entity selection. It may help. Second, it supercharged your ability to front-load deductions through 100% bonus depreciation and cost segregation. If you're already planning to invest in your business or in properties, the timing and structure of those investments now matters more than ever. And then third, it tilted the math on debt, tips, overtime, and SALT in ways that can either quietly erode your wealth or quietly accelerate it. We vote for accelerating it, depending on whether you ignore the changes or lean into them. The IRS already has a strategy for 2025 money. The question is, do you? If you want help building one, I've created a simple one-page resource called the One Big Beautiful Bill 7-Play Checklist for business owners and real estate investors. It walks through the exact plays we just covered: entity and compensation, capital spending, debt, cost segregation, real estate professional status, SALT, plus a few questions you can literally hand to your CPA to kick off a real planning conversation. Subscribe to the podcast, and we will make sure that you get availability to that checklist. And if this episode helped you, please do me two quick favors. Hit follow or subscribe wherever you're listening, and leave a rating or review so more investors and owners can find the show. And then second, share this episode with one person you know who owns a business or a rental. Send them the link. Tell them you need to hear this before your next tax strategy session. This has been the Tax Strategy Playbook. I'm David Wiener, known as Mr. Cashflow. You've got the playbook. Now it's time for you to run the plays. I'll see you in the next episode.
Thanks for listening to the Tax Strategy Playbook. If you found today's strategies valuable, be sure to subscribe, leave a review, and share the show with someone who wants to play smarter with their money. You'll find more resources, tools, and expert tips at taxstrategyplaybook.com. After all, it's your money. Keep more of it.